Good afternoon, everybody, and welcome to today's webinar with FX Street. Thank you, everybody, for joining, and thank you, FX Street, for putting this on for us. Really appreciate it. In today's webinar, we're going to talk about a little concept that some of you may have looked at before, but what I've found through teaching people with all of our members and things is that far too few people actually do look at this. There's a lot of people that are looking at finding that 100% system. They want to find the system that basically gives them 100% winning trades, and they'll just keep chopping and changing between different systems. But very, very few people actually sit there and look at what they already have and look at making little tweaks here and there just to eliminate one or two losses here or there and end up with a very good system that may not be 100%, okay, may not even be 95%, but it produces a system that will allow you to make money in the markets, which ultimately is what this is all about. So we're calling this webinar Say No to Losses, the simple trick that will help you immediately eliminate losses. And we're not saying it's going to immediately eliminate every single loss out there. That's just a ridiculous thing to say. That's not what we're talking about at all. We're just going to give you one very, very simple strategy that you can utilize today that will automatically take out a good portion of your losses, without you having to do any real sorts of analysis. Okay? And by doing that, as we'll demonstrate to you later, that also has a massive impact on your bottom line. So before we go into the webinar, though, we have to go through the disclaimer. And that says the content of this webinar is not investment advice and should be used purely for educational purposes only. All participants are advised to seek their own counsel prior to investing or entering into any trade. Spread betting and any other type of financial trading carries a high level of risk to your capital of the possibility of losing considerably more than your initial investment. The content of this webinar may not be suitable for all investors, and an individual should ensure that they're fully aware of the risks involved, and if necessary, should seek the advice of an independent financial advisor. Okay, now we've got that out of the way. Let's talk for a moment about the retail trader. The retail trader, that's basically most people that will be watching this webinar right now. It's a good proportion of the FX market as well these days. I saw a recent statistic that showed that the retail market is growing and growing day on day. Now, the retail trader, the goal is always to find sort of that 90 to 100% winning system. At least that's the goal in the beginning. When you haven't been in the markets for too long and it's all very sort of new to you, you think that there must be a way. There must be a way for you to find a system that basically gives you more or less 9 out of 10 winning trades. But that doesn't stop the retail trader embarking upon the indicator spiral. Okay, if they don't chop and change they don't chop and change their trading systems every 2 weeks looking for that one amazing winning system that makes them, as I said, 90 to 100% winning trades, then they embark upon the indicator spiral, where they add lots of different indicators, okay, looking for that one magic combination that can keep you out of all losses and catches all of the big winners. All of you that are watching this right now, if you just think to yourself, if you've been in that situation before, I'm sure if you're honest with yourself, you will have been. You've either sat there when you first came to trading and you were looking for a strategy that could make you, as I said, 9 out of 10 winners. So out of the 10 trades, every 10 trades you take, 9 of them will make you money. Or you've sort of found a particular strategy. You haven't necessarily gone system hopping, but you certainly have tried to optimize a system. So you've said, you know what? I didn't have to take that loss there. If I just added this indicator here, that would have kept me out of that losing trade. Or if I just took out this indicator here, that would have got me into that winning trade. How many of you on here have done that before? Looked at the market, looked at your charts, looked at either a losing or winning trade, and thought about what you could do right there and then to your system that would have either got you into a trade or got you out of a trade? We just have a quick yes or no into the chat box there. I'm thinking it's going to be a good proportion of you, or good portion of you. So retail traders very rarely are able to accept the fact that losses are a part of the game. And even fewer traders will settle for a system where they're right sort of 50 to 60% of the time. Although, believe it or not, a system like that, even if you're successful 50% of the time, can still yield you a significant return. We're not necessarily talking about a return today or tomorrow, but over a few weeks or a few months, a large enough sample size full of trades, a system where you're only right 50% of the time will make you money, assuming you've got the right risk reward. Okay, so let's imagine for a second that you did settle for a system where you were right 50% of the time. What would that mean for your bottom line? Let's go through a few examples here. So let's assume that when you were wrong in this 50% trading system, you lost 1% of your capital. But when you were right, you gained 1.5% of your capital. Okay? So over the course of 100 trades, you would take 50 losing trades and 50 winning trades. Your losing trades would have cost you 50% of your account. Your winning trades would have made you 75%. Okay? If we take the negative trades away from the positive trades, you would see that you still made 25% profit in the year. That's just a 50% strike rate on a 1.5 to 1 risk reward, which is very, very achievable. Okay, if you're looking for, a 50% strike rate on like a 10 to 1 risk reward, yeah, I'd have to say that it's unlikely you're going to get that. Okay, but 1.5 to 1, 1.5 to 1 your risk, you can absolutely achieve that trading the markets. But what happens if we made a little tweak? What would happen if we were able to push our strike rate from, let's say, 50% to 60%? And again, let's assume that when we're wrong, you lost 1% of your capital. And when you were right, you gained 1.5%. Well, over the course of 100 trades, this is what your return would be. The 40 losing trades would have cost you 40%. The 60 winning trades would have made you 90%. Your net profit there would have been 50%. And that's not doubling your output, as in increasing your winning percentage by, 100% or 50% or anything like that. That's a small increase from 50 to 60%. Okay? So we don't have to do anything phenomenal to get you to the point where you're achieving that. There are some very simple tricks and tactics that we're going to talk about here on this webinar that will allow you to push your strike rate up. And as you can see there, even a little bit can mean a lot. So a 20% increase in your strike rate, so you go from 50% to 60%, equals 100% increase on your return. So you go from 25% to 50% with a positive risk reward. So a small change there, as I said, and this is the exciting part. This is how you should look at things as traders. Look at those small little tweaks that you can make to your trading strategy that will have a massive impact on your bottom line. And you don't even have to do a lot to achieve that. So as you can see, a 10%, so going from 50 to 60%, so a 10% increase in your strike rate improves your return by 100%. Because often trading is about fine margins. With a positive risk reward, small tweaks can improve your bottom line in a big way. But the great news is, to achieve this sort of an increase, you don't have to find that magic indicator combination. You don't have to find that magic system, that shiny brand new system. You simply need to apply one common sense technique, and your strike rate will improve and your bottom line will improve. So here's the question. Have you ever had a trading period where you've had a feeling about the overall direction of the market, only to find that at the end of that period, you'd actually lost money? So whether that be over a day, a month, a year, a week, whatever that is, your gut has told you that the markets are going to trend in a particular direction. But then at the end of that period in time, you see that the market has gone in the direction that you anticipated. But somehow you lost money during that time. Steve is being honest here. Thank you very much, sir. How about, have you been right on the trade only to find that you've been stopped out due to having a stop that's too, and that should be two with a double O there, bad English, apologies, too close to the market, and hence you haven't profited at all? So kind of similar to the last one there. So you've been right about a trade, but you've been poor in your execution. I'm sure there's a number of you out there. You see, you're all in the same boat here. The good news is that you're not alone. These issues are issues that every trader faces, even if you do not want to admit it. Even if you're the guys on the other end of that boat there saying, sure, glad the hole isn't at our end, because that's not going to affect you. It affects everybody. You see, there was actually this study done by a broker, and I heard this in an interview on one trader podcast. There's a study done by a broker that found that a good proportion of a particular broker's losing clients were often right on the direction, but wrong on the execution. And I don't know what time they measured this over. Okay, I don't know if this was day trading, long-term trading, if they measured this over a week, a month, a year's worth of data, and what the criteria was. But ultimately, what came out of it is that retail traders are actually not that bad at picking the direction of the markets. They're just horrific when it comes to execution and managing their trades, which shouldn't really come as that much of a surprise to you. So the big question is, well, what can you do about it? Assuming all of that is true, what can you do to improve your strike rate and improve your management of a trade? The answer is a complete paradigm shift. The one fundamental change that you must learn is to trade with a bias. Okay? That is what you have to do. Now, once you're experienced, you can remove this, because you have a better idea of where the market's going. You have a better idea of how to read the markets. But for the majority of new traders, this one thing right here is going to improve your trading results. Okay? And that's to learn to trade with a bias. What this means ultimately is developing a view on the market direction for your particular time horizon. A view isn't necessarily a signal to enter. A view is simply, I think that generally the euro dollar, for example, is going to go down over the next 3, 4, 5, 6 months. That's a view. You could even apply that to a day trading perspective. Your view could be that oil is going to sell off today. That could be your view. Now, trading with a view, does that mean that you won't have any losses? Absolutely not. You will still have losses. But what you should find is that trading with a view allows you to trade in the direction of the rest of the market, in the direction of the trend, the currents. And as a result of that, your trades stand a much better chance of success. So the question is, how do you develop this view? And you could do it a number of ways. You could do it technically. You could do it fundamentally. You pick the skill sets that suits you most. Okay? So for example, you could pick a technical view based on the trends, based on key levels, structural levels, or even moving averages. Whatever it is that you feel comfortable with, you can utilize that to start to establish a view, an idea on the direction that you want to trade in. You could use fundamental analysis for that. You could base it on economic indicators. If you're day trading, maybe you might say that if the non-farm payrolls come out really negative today, then maybe we'll sell dollars, for example. Or you could do it on central bank policy. For example, if you were sat here maybe 18 months ago, there was a very, very obvious trade on the table, which was short the euro dollar, based on the divergence in monetary policy between the European Central Bank and the Federal Reserve. The Federal Reserve was saying that they were going to raise interest rates at some point. The ECB were doing exactly the opposite. They weren't ready to raise interest rates. They were going to embark upon more QE. That view right there, as I'm going to demonstrate to you later on today, would have been enough to make you a very significant return over a period of months. Now, you could have day traded that. You could have traded it from a swing perspective. You can do both. It just depends on what sort of time horizon your view is. So, for example, that on the central banks, yes, you could have day traded it, but that was more of a longer term view. I wouldn't necessarily have just traded that on a 2 or 3 minute chart. That would be something for like the hourly charts, for example. Does that make sense so far? You see, this doesn't need to be complex. It just needs to be something that will stop you trading both sides of the market. You can even trade commodity prices. You can use that to try and help you identify direction for the currencies. Or you could just trade what's in vogue at the moment. What are the market focusing on? Are they focusing on the Brexit, for example, which is going to be negative for the pound? You find every opportunity to sell the pound. You don't buy the pound. Are they focusing on the fact that, hypothetically, because we don't actually think this is true right now, but the Federal Reserve are going to raise interest rates? You look for an opportunity to buy dollars. But as I said, from our view currently, is that we potentially aren't going to get the 4 rate hikes that they promised us back in December. The data hasn't been strong enough for that. But things can obviously change. But the point is it doesn't need to be complex. As I said earlier, just something that's going to stop you trading both sides of the market. And let's go into a couple of examples. So one example of a trade that we've taken recently is that of the pound yen. We wanted to short the pound because there's a lot of negative energy towards the UK at the moment. Will we not exit the Eurozone? What will that mean to our economy? What will that mean to the jobs? You know, it's very, very negative. Now, we could have gone for something like the pound dollar. But that's seriously oversold at the moment. And the US has some sort of issues of its own anyway. So we felt that trading the pound yen was going to give us much better, cleaner, clearer opportunities. And that's exactly what we got. Okay, you could have traded this a number of ways. You could have even traded it technically on a break below this level here and only looked for short opportunities all the way down. As I said, we looked at it fundamentally. So we were in on this pullback and this pullback here. But even if you don't trade the daily charts, this is what that last down move looked like from the 1 hour chart. We were involved in this as well. So going back to this here, see this little down move right here? That is what we're looking at over here. So even if you trade it technically, right? You don't even look at the fundamentals. So you take your direction from the longer term time frame, being the daily chart here. You can see that this is down. So then you look for opportunities to short on the shorter term time frame. This one here. when the market breaks structure, during a pullback, when the market breaks structure again. Any one of these opportunities would have paid you very handsomely. And notice that, let's say, for example, you're trading technically, you can see the downtrend on the daily. You're not even looking for buying opportunities. So you're not looking to get into trades that basically stand no chance of success whatsoever. In terms of what will happen, Emmanuel, if we stay in the Eurozone or not, it really depends where the pound is at the time and what else is going on at the time. But you can imagine that if there's been a lot of negative pound energy, the pound's been sold a hell of a lot going up to the decision, and then the decision is actually to stay, then the pound will at least get some respite and will bounce a little. But as I said, that's kind of like a different topic. That's something that we need to look at when we're approaching that time, see what else is going on in the world at that time. Does that make sense? What about a nice fundamental theme here? The euro dollar. The euro dollar, back a couple of years ago, was the most obvious shorting opportunity in the history of trading. You had one central bank that was talking about raising interest rates, and you had the other one that was at the complete other side of the spectrum. And based on that fundamental view, we traded the euro dollar short over the past 18 months-ish. We're over that now. Based on that view, we didn't even take any of these opportunities to go long, whether they would have paid you or not, because eventually the trend would have reasserted itself. And if we were in buying trades, we would have lost money, which is not what we want to do, right? How about one that, yes, it was fundamental, but you could have found it technically as well? The fall in oil prices. That's plain to see, right? You can see this chart falling off a cliff. You can see that from back in 2014. It's going lower and lower and lower and lower. But we're not saying sell oil. No. You can take your direction from oil. You can look for a commodity currency that's dependent on that particular commodity. So you could have done something like looked for weakness in the Canadian dollar. And again, you're only looking for one direction. Your directional bias is to buy this pair. So buy the dollar CAD, in expectation that the dollar will appreciate against the Canadian dollar. Again, if you look at it fundamentally, this actually had a lot more going for it than just the technical fact that oil was falling off a cliff. But you can trade it both technically and fundamentally. The point is to develop a bias in one way or another, to develop an idea of a direction that you want to trade in, and then only trade in that direction. And by doing that, you automatically start to eliminate losses. So as you can see, by trading in one direction, you automatically eliminate the opportunity to make losses trading both sides of the market, which is often an area that retail traders end up losing their account. They get frustrated on one side, they get frustrated on the other side, and they keep losing money. But by trading in one direction, your strike rate improves as a result. And as we saw earlier, even small improvements in your strike rate can make a massive difference on your bottom line. So stop looking for that 100% system. It doesn't exist. And if it does, it will only work for a certain period of time, and then you will blow up. If you pick one direction to trade in, whether it be technically or fundamentally, oftentimes you will find that you are ending up trading in the direction of the tide. And hence even bad entries can be saved by the overall market direction. So your strike rate goes up that way as well. Is everybody following so far? Excellent. So what else can you do to improve your strike rates? Well, there are two primary things you can do. You can trade smaller. Okay? The larger position you have on the table, the more likely you are to interfere with that position. So if you trade smaller, you get to a point where you don't really care about the outcome of the trade. You're just interested in the process of it. And by doing that, you allow your trade enough space to be able to make you some money. So trade a smaller size. Get down to a size that you almost don't even care about. And I'm not talking about something ridiculous where you actually don't care about it. You need to have some skin in the game. You need to care about the trade enough to make sure you're putting on the right trades, but not too much that you sit there looking at it every moment of every day, wondering what it's going to do. You need to have a trade size that's large enough that it's going to have an impact on your account, that you care about the outcome somewhat, but not so large that you're sat there watching it every second of every day. The other thing that you can do is that you can place your stops behind major levels on a bigger time frame. This technique alone will help you stay with winning trades longer. Okay, because to start with, you've got your stop further away, so little arbitrary wiggles in the markets won't affect you. And as your trade in the market trades further into profit, you'll find that smaller swings start to mean less and less. So you're happy to leave the trade on the table that little bit longer. So in summary, the aim of the retail trader is to find that 100% trading system. They do not realize that improvements, slight, small improvements, can actually have a massive impact on your bottom line. Small. We talked about the jump from 50 to 60% there, strike rates, which you can all achieve. And that small increase provided a massive increase on your bottom line. Okay? So developing a bias for your trading is the single best thing a new trader can do to improve their results. By trading this way, you automatically, without having to do any analysis on the position itself, so yes, you'll have to do some analysis to develop your view, but on an individual position basis, you remove a portion of your losses just because you're not trading in that direction. Also, you need to understand that trading smaller is smarter. You see, as I said earlier on in the presentation, oftentimes retail traders, they're right on the direction. You are right. You pick the direction of the market to a T, but you do not make money from it. It's because your execution is poor, your position sizes are too large, that you want to come out of it as soon as the market goes against you a little bit. Or as soon as you have that little tiny drop of profit on the table, you want to take it. Just in case the market turns around. Which it can do, and it will do. But more often than not, you will make money. So you want to have smaller position sizes, larger stops that allow you to stay with the trade longer and avoid being whipped out of insignificant market movements. You know, like those sort of yellow or orange data releases, the minor ones, the ones that aren't so hot. Sometimes if your stop is too close, you can be taken out of a position based on one of those economic announcements, regardless of whether your trade has merit or not, and regardless of whether you would have made money in the long run. Okay, so you want to place your stops a little bit further away. So look at trading, let's say, for example, on the 60-minute chart, but placing your stop on the 4-hour or the daily chart. And I promise you, you will see results. Does that make sense to everybody? Are there any questions? You're supposed to swing. This is swing trading. Not necessarily, Steve. You can apply this to day trading as well. Let me show you what I mean. So let me bring across the charts. Whoops. Can you see this chart here? Yeah? So you could look at your chart. And this is a chart on oil, right? Fundamentally, I'm quite negative about oil. We had the Doha agreement falling over yesterday, which made me a nice bit of profit. But today, the market has pulled back somewhat. And depending on where this closes, okay, you could then develop a bias for day trading tomorrow. So looking at this candle right here, you can see at one point in time it was very, very negative. But since then it's climbed over 100 points, 200 points even, on this one daily candle. So if this candle finishes up towards the top around there, my bias for tomorrow is going to be bullish. Okay? From a very, very short-term perspective, I'll be looking for the market to break out above this candle here. And when it breaks out above that candle, I'll be looking for a little bit of profit to the upside. You also could have traded today, fundamentally, based on the news last night or yesterday, that the Doha deal had fallen apart. You could have said, you know what? That's going to be negative for oil. Let me go and look to see if I can take a position on it. Okay, and depending when you manage to get there, you potentially would have had an opportunity to make some significant money. Do you follow what I mean? Yeah? Excellent. So who here is going to attempt to implement that in their trading? Yes, exactly, Hans. When you're day trading, you pick your bias before you start the day. And things can change during the day, but it needs to be something quite significant to help you change your bias. Well, do me a favor, for all of you that are going to implement this in your trading, take a snapshot of what your trading looks like right now, and then a snapshot of what it looks like in a month's time. And then drop me an email and send me that email. In celebration, okay? support@traderscorner.co.uk. Send me an email to that address there, referring to this webinar right here, and gloat about how well you are doing. Okay? I want to see all of your results. I won't be surprised by them, but I guarantee you will. But it's very important. Look at what your trading is like now. Implement this and then look at your results afterwards. Are there any questions from anybody? No, makes sense. Would you have a line in the sand where your bias will change during the trading day? Yes, potentially, Hans. So let's say, for example, you were trading oil, and let's say that the market was trading up at this level here. That could be your land in the sand. Your land in the sand? Your line in the sand. So you could say, anything above this level, I'm looking for long opportunities. Anything below this level, I'm looking for short opportunities. You do them at key levels, Hans. You can trade both sides, Abdul, once you get a little bit more experienced at this. Once you understand how to read the markets, then you can trade both sides of the market. I do this often with my day trading, but kind of like what I was showing Hans there. So I trade one side as long as it's below a particular position, or another side as long as it's above a certain level. In terms of the pound Aussie, your bias has to be short. I mean, this isn't investment advice, by the way. Oh, pound dollar, sorry. I read pound, I saw GA there. Obviously, I can't read, so let's go pound dollar. So the pound dollar, from a technical perspective and also from a fundamental perspective, so the technicals are reflecting what the fundamentals are saying. This is a bit of a difficult one because both of them have negativity going towards them. On the one hand, you've got the UK and will it exit the Eurozone? On the other hand, you've got the US who have promised rate hikes. Okay, they indicated there would be 4 this year, and traders position themselves accordingly. But now we've had some really weak data out of the US. Yes, granted, in the last month it's definitely ticked up. It's a little bit better. But there's still negative data coming out of the US. So we don't quite know. It's a little bit uncertain at the moment. There's no real bias in this pair here. You'd be much better off choosing the pound against something that's stronger. Okay, or the dollar against something that's stronger. That's going to be a better trade. So pound yen, dollar yen, for example, would be able to provide you with opportunities. Look at that there. So Hans is saying technically the bias for the day on the DAX. Technically my bias for today was a little bit mixed. So it opened up down and I kind of saw that there would be a closing of the gap. So I traded to the upside slightly, Hans. Okay. And then if we went into a very short-term chart, you'll see some behavior that caused me to think that perhaps the market might go lower. And that was at this point in time here. So the market traded up, it came down, it went to trade up again. I thought this would be a bounce to the upside. So I thought, yes, let's continue with our opportunities to the upside. It then failed to go any higher. And started to break lower. At this point in time, I changed my bias and put on a short opportunity to sell this here. But it didn't hold below there. And when it closed back above and started to close above this level here, I added to some of our positions and eventually took them off a little bit further back there. Actually, further back here. Does that make sense? Are there any other questions? No further questions from you, Emmanuel. Excellent. Dollar CAD. Now this one, the tide could be turning. Okay. Really depends on what oil does over the coming weeks and months. If we find that the fact that they didn't manage to come to any particular deal in Doha, okay, has a big impact on the markets because oil did rally somewhat going into that. But if we see that that's negative, we could see a resumption of the uptrend here. But we need to see how the markets absorb that going into the next week or so. And that will give us an indication of where this pair is going to go. Okay, so in answer to your question, if oil starts to go short some more, and to be honest, at the moment I've got a couple of short oil positions on, so that is where I think it will go. I might be wrong, I might be stopped out. But if that is the case, then we can see a resumption of this uptrend here. Okay, if there are no other questions, then we can wrap it up here. I hope you all enjoyed this webinar here, and I hope you're all going to take it on board and go and practice, see how it would have paid you in the past. And as I said, if you do happen to utilize this particular technique here, please send me an email in a month's time and let me know how you've done. Okay? Because this is the one simple trick that you can apply to your trading right now that will have an impact on your trading right now. So thank you very much for joining, giving up your afternoons. Thank you, FX Street, for putting on this webinar. It's been an absolute pleasure. And I look forward to doing it again next month. Okay? So have a really great day now. Great end to your day. Good luck with putting this into action. If you've got any questions, please, as always, feel free to drop me an email. You've got my email address now. Otherwise, take care. Have a fantastic day. And I'll speak to you on next month's webinar. Okay? So have fun now, and I'll speak to you all soon.